can you have a trade blow up on you, lose $13,000, and have a hedge in place that not only gets that back, not only gets you to green, but actually makes you more profit than your original trade was intended? That's hedging, folks. Hey folks, today is February the 23rd, 2021. It's a Tuesday evening, and I wanted to make a commentary on the power and importance of hedging. Hedging your trades, building a trade and then trading around that trade. And really how it's almost, I believe, a necessity in a lot of trading strategies. Primarily the zero data expiration. So just a quick note, we've just been killing it. Just been killing it on the zero data expiration trading. Just for me, without a lot of capital. And when I say not a lot of capital, you know, sometimes I'm deploying $200,000, $250,000 in a zero data expiration. Lately, I have been what we like to commonly refer to nicely as capital constrained, where I was you know, starting off with $10,000, $15,000 in a trade, maybe at the most committing $40,000 or $50,000, but a lot lower levels than I generally do. So anyway, you know, with $15,000, with $20,000, $25,000 of capital committed in my trading, just every day, knocking out a $1,000 profit, $1,000 a day, $1,000 a day, $1,000 a day. Monday comes along, yesterday comes along, and we did not blow through. If you let's take a look here at just Mondays. I won't go into all of the trade details because that's not really the point of this video. I want to talk today about hedges, but you can see right there, that's Tuesday. So here's Mondays right there. That's Monday's trading. Now you look at that chart, you're like, man, that looked like a pretty flat day, right? Well, we sold some puts up here, and the market just sold off, sold off, sold off. It did not finish through both legs. It was in between those both legs at expiration. And so I had roughly $18,000 at risk, $18,000 of capital in my zero date expiration on Monday, and ended up losing about $13,000 on that. $13,000 loss. Now that was mitigated a little bit by about a $3,000 or $4,000 profit that I had in a hedge. So I was net down about $9,000 for the day. It's still, you know, better, but still not good, right? I'm going to show you how I don't believe that is a big deal. I don't believe it's a big deal because I think that my hedge that I still have in place will more than make up for that. And when I say more than make up for that, I'm saying that it's not going to get me back to break even. It's going to get me into the profits. And, you know, I'm going to stick my neck out here and say that I think that it is going to not only get me back to break even, not only get me into the green, but the profit potential on my current hedge is bigger than what the profit potential on the zero data expiration was. And I think it was about, you know, I had $18,000 tied up in it, and my profit potential was about $2,100. You know, so that means that I've got to make back something like $15,000 on the hedge overall to meet my objective. Now, I try to be very transparent in all of my trading. You guys know I trade my own real hard-earned money in a real account. No paper trading, none of that stuff. And I show you the good, bad, and the ugly. I mean, here I am making a video talking about a $13,000 loss that I had on Monday, right? So we don't sugarcoat stuff here. We show you the good, the bad, and the ugly. And I could very well wait until after this hedge has performed and done whatever it is going to do, and then show you the result then. But I'm going to put my neck on the chopping block right now before we're even there, and say, I don't know if it's going to be tomorrow or if it's going to be next week or next month, but I feel very comfortable that this hedge is going to not only get me back to break even, not only get me into the green, but generate a bigger profit than what the trade would have made me anyway in the first place had it worked out perfectly. Okay, so again, that's what the point of this video is talking about the importance of hedges and how they work. Now, the first thing that you do when you're looking at hedge, remember that a hedge is, generally speaking, very directional in nature, right? So I am just by heart, just by nature, I attune. I feel comfortable with credit type trades. My online handle, if you will, is Theta Seller. So that kind of tells you what kind of trades that I am more adept at. And that's where we essentially, with any type of credit trade, that's just simply where we are trading ranges rather than direction, right? We're not looking for directional moves. We're looking to pick ranges and define those ranges and set up short legs around those ranges. But a hedge is a directional, generally speaking, is a directional in nature type investment. And so the first question that we always need to address when we're looking at a hedge is, what do you think that the position that you are trying to hedge is going to do? Is it going to be bullish or bearish? Now, for our purposes, zero-date expiration, what we are hedging is the market, the S&P 500. And so the question is, are you bullish or bearish on the market? Now, in our chat room today, I was in and out today trying to keep one of my cars running that seems to be in the shop more than it is drivable lately. But anyway, I digress. I saw some comments in there about some people that were bullish on the market, and they were buying some E-minis overnight or things like that, or something like that. But anyway, they were bullish, right? Bullish on the market. And first of all, so I disagree with that stance. Now, first of all, you're probably right, because I am wrong more than I am right. And one of the cool things in our trading room is that we are all honest enough and open enough and humble enough to admit that, none of us know, right? None of us know what the market's going to do. If we knew what the market was going to do, we would be billionaires. We would all be billionaires, right? So we don't know. You got a 50-50 shot, If you say you're bearish, if you say you're bullish, heck, you got a 50-50 shot at being right. But the thing that I was thinking about was, whatever your stance is, whether you are bullish or like me, you're bearish, you have to have some way to validate that belief. Even if the data set that you use to base your belief on is erroneous, it still needs to exist, right? Like, you still need to be able to point to something. You can't just say, oh, I feel that the market is bullish. I feel that it's going to go up. That's just my sense. I just sense that it's, no, you got to have some form of data set to look at. Okay, so that's the first thing. Again, you could be completely wrong, right? The premise that I'm going to lay out for you here, like, I'm going to lay out a bearish stance for my view on the marketplace, and tomorrow the market's going to open up, the S&P is going to open up 60 points to the upside, right? Like, who knows? But you do have to have some data set that you use to formulate your thesis, your stance, right? So one of the things that I look at, and again, I've talked about this a bunch, but there is, I think, 11, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, excuse me, 12. So I look at 12 major technical indicators, and then we do a double overlay of moving averages on top of that using both simple and exponential, all the way from a 5 period to a 200 period. And these are dailies. I'm usually 5 day to 200 day moving average. And that gives us an overall rating of a strong sell signal, neutral signal, buy signal, strong buy signal, right? Those would be the ranges of signals that we would get. So number one right now all of our technical indicators are really giving us a strong sell indicator in the stock market. Not a sell, but a strong sell, right? And even if it was neutral at this point, you know, that's something to kind of, you know, you start going, okay, let me look at this a little bit closer. Strong sell indicators. Now, we still have buy indicators in our moving averages, but remember that moving averages are lagging indicators, right? They are just a compilation of historical data that smooth out trends. And which one of your moving averages is going to adjust the quickest? Well, the shorter the term of the moving average, the smaller the amount of data set inside of that moving average, the more agile it is, right? So your shorter term moving averages are going to flip and give you a crossover point, give you a buy or a sell signal a lot earlier than your longer term ones. This is a little bit like the weather reporting with moving averages. If you asked a weatherman, what is the weather going to be in your area tomorrow, they're pretty darn accurate. Like, they can almost tell you down to the hour, you know, when that storm cell is going to pass through and how much precipitation it has and what the probabilities are and all that kind of stuff, right? If you ask them what the weather is going to be a month from now, they don't know. They're going to take a guess, but it's just a guess. And their guess is no better than yours, right? The moving averages are a little inverted in terms of that analogy that I just gave you. 200-day moving averages are ridiculously accurate. Ridiculously. If the only, when people formulate these massively complicated investing plans, guys, you could do well if you took your entire life savings, threw it in the SPY, and when the market was above the 200-day moving average, you were long the SPY, and when it broke below the 200-day moving average, you were short the SPY. That's it. That's the total system, right? So the 200-day moving average, very, very, very high level of accuracy, but very slow moving. It is very, very slow moving. You're going to get much quicker buy and sell signals off of a 5-day, a 10-day, a 20-day, a 30-day, a 50-day, but not quite as accurate, right? Because they don't have as much data set inside to draw from. Law of large numbers doesn't quite come into effect as effectively. So that's why we use all of these. But the point being that your shorter term moving averages are going to flip earlier than your longer term ones. So while we are still in a buy mode based on moving averages, well, you can see that they're pretty much all the short term ones, they're starting to roll over, right? They're starting to roll over. So from a technical standpoint, I look at the market and I say, well, okay, it's bearish. We look at a chart here, and you know, you can see if you would have just said, and if you are of that stance right now where you say, oh, well, I believe the market's going to go up tomorrow, boy, you would have been right a lot more than you would have been wrong. Correct? I mean, there's the March sell-off with the pandemic hitting, and then really, you know, ever since then, with just a couple of little hiccups, it has just been up, 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 up in the marketplace. But you can see here just recently what's been happening, right, in the marketplace. Now, this is by no means a sell-off. It's really more than anything the market just kind of getting tired. Guys, we're at all-time highs. We're at all-time highs in the marketplace, okay? Now, today we had a huge sell-off, big drawdown. Isn't it interesting? I know this is a little hard to see right here. What did we use, or what was it that helped us find support today in the marketplace, stop us from continuing to go down, and allowed us to rebound back to essentially break even today? We were down, you know, over 40 points on the S&P today at one point, and basically finished flat on the day. Basically finished up like $4 on the day. So basically flat. What allowed us to do that? Well, right, this little blue line right there, that's the 50-day moving average. And you can see, guys, you can see what the 50-day moving average did for support and resistance right there. Sort of support right there, great support right there, support right there. What was support became resistance. What was resistance became support. More support right there. And it has been great. It was a great line of support right there when we had our last little test of are we going to flip from bullish to bearish, right? We're in another test of that right now. We came right down, touched that 50-day moving average, came right back, okay? So you may say, well, that's bullish, right? To me, it's bearish because you're always, look at that 50-day moving average. You're always going to test that. You're going to test that level of support resistance for a couple of occasions, a couple of occurrences before you just blow right through it. The market doesn't just shoot up through the 50-day moving average or crash down below it. Usually, it generally speaking is going to test that for a couple of occurrences, a couple of trading days, right? So it'll be interesting to see what it does do tomorrow and the next couple of subsequent days, the rest of this week. We do have a few more days left in this week. It'll be interesting to see where we end up Friday of this week, right? But the first point, I guess, that you have to make on a hedge is you have to decide what your stance is. Now, here's why I feel like bearish is the best stance for building my hedges, okay? This is why. So we talk about this concept with the stock market, that the stock market takes the stairs up and the elevator down. The big, massive moves in the stock market are usually to the downside, not the upside, right? And of course, you see the pandemic. Fear is a bigger driver than greed. And so we do get a bigger move to the downside than the upside. But what we have been seeing in what is admittedly just amazing, rock solid bull market for this last year is what we call rug pulls. Okay, we've been having rug pulls. So you see the market kind of doing its thing, and then boom, rug gets pulled out from underneath us. Market's kind of doing its thing, boom, rug pull. Another rug pull, right? And you see here that the percentage moves, the ferocity of the volume and the directional move, the size of the candles, much bigger on the downside than the upside, right? So the question here for me is, we're at 38.81 right now. 38.81 is where the market finished up today, Tuesday. Where could we go to the downside? Well, for me, the next target is 3,700. Right down in this area. That was our last support level right down there, around 3,700. It's also down below our 50-day moving average. And if we break the 50-day moving average, guys, man, a lot of times, not always, but a lot of times that signals look out below, right? So for me, I look at it and I say, okay, what's the risk if I'm bullish? Well, the risk is pretty big. The risk is asymmetric, right? There is more risk than upside. How much upside does this market have? Now, I know, you could have said that back here, right? We were at all-time highs in the marketplace right here. Pandemic hits, we sell off. Holy smoke, everything's going to heck in a hand bucket. And we just bounced right back. We bounced right back. We didn't quite get back, in a very short period of time to our all-time highs. But for all intents and purposes, we did, right? Bounced right back to these all-time highs. And so it's easy to say that there is a lot of risk if I am bullish of sitting out of these marketplaces. But guys, right now at this point, how much more upside does the market have? What valuation metric are you looking at that tells you that this market is undervalued? That now is the time to jump in, right? What? Because I don't see that, right? So the risk to being a bullish trader is rug pulls, right? The risk is rug pulls if you're bullish. I don't think the risk is that you're going to miss out on some amazing results, some amazing returns. The risk is to the downside if you're bullish. It's these rug pulls that's going to get you, right? What's the risk to me if I'm bearish? Well, the risk to me if I'm bearish, guys, I think the risk being bearish is better than the risk being bullish. Because if I'm bullish, I have these rug pull scenarios here where the market could literally drop 5 to 10%. That's my risk if I'm bullish. What's the risk if I'm bearish? The risk if I'm bearish, guys, is that I just get more of this crap. Excuse my French. I just get more of this stuff right here, right? Which is just the market just grinding higher. It's just grinding higher. So I'm going to show you my hedges that I have on in place right now that I've been working, and why that wouldn't matter to me. These hedges are positioned so that if the market crashes, I'm rich. Now, when I say I'm rich, they probably bring in 40 grand, but remember that these hedges are not designed to get me rich. They're designed to get my profit back from my 0-date expiration trade that I did yesterday, right? That $13,000 that I lost, the hedges are designed to get that back. So if I got $40,000 back off of a $13,000, yeah, that would be great, right? So if the market crashes, I'm sitting on easy street. If the market just slightly goes down, they're making money, and it's just going to take longer to get my $13,000 back, but it still works, right? Even if the market goes nowhere, if the market just does this, which is what it's been doing, you know, for 2 weeks now. If we do for the next 2 weeks what we have done for the last 2 weeks, which is kind of just trade in a consolidated range, I'm still bringing money in on my hedges. So it still works then. It even works. These hedges will even work if the market is going up, but just gradually, just in a small amount. Not if the S&P goes up 40 points in a day, but if it just is a gradual move up, I'm still bringing in more income off of these hedges than I am losing from my negative delta, and the market obviously driving to a positive delta. Okay, so let's look at the hedges. Let's talk about them a little. So with my bearish bias now, let's take a look at why I feel like I'm in a pretty darn good position to kind of say with confidence that I am going to not only get that $13,000 loss back, but actually get into the green, and not only get into the green, but make more money off of my hedge here than the initial trade actually was designed to make. And again, had $18,000 in that trade, lost $13,000, and I think the profit was maybe as much as $2,000 on it. So, you know, I gotta make 15 grand. I gotta make 15 grand back on the hedge here to meet my expectations of what I'm kind of sticking my neck out here saying I could do, right? So first of all, let's just do a little checkup on my history here. So I'm going to come back to let's just see what I'm looking. Here is, well, let's start with the micros. Let's start with the micros, and then we'll see where we're at for the time frame. So this would have been the 22nd, right? That's yesterday. And we'll look at through the day. I did have, I think, some E-minis on. Maybe not. Let's just double check again. Let's go to maybe Sunday. There they show up, finally. Okay, so step number one. I'm going to kind of walk you through my setting up of my hedges. Step number one is I start with the micros, the MES, okay? 1/10 the size of the E-minis. So again, I want to kind of start small and ramp up, right? If you want to keep dry powder available for your initial trades, you really want to do that with your hedges, because that's your last shot, right, to save a trade, is the hedge that you have on. And so I started with the E-minis on Monday, and you know, I bought 8 at $38.90 and I sold them at $38.94. So didn't even make a couple $100. That is, in terms of getting back my $13,000, that's a step in the right direction, but it's not enough, right? So step one is I will start with the E-minis. If that looks like that's enough to do the job, then that's fine. If not, I ramp up or I graduate to the ESs, to the E-mini futures. And so that's why I didn't do too many micro trades here, because I knew that I was going to have to put a lot more substantive effort into recouping this loss. It wasn't a $1,000 or a $2,000 loss. where maybe just a roll of a few strikes would have fixed it. $13,000 loss, right? So I moved into the E-minis, and again, I won't take the time here to go through all of those positions, other than just to say again, this is scalping. As it's moving up or down, I'm scalping with that in a directional manner, while my iron condor is sitting there static. And so that was I was able there to bring in about $4,400 on those E-mini trades. So, you know, now we're starting to get somewhere. Now I only need to make $8,000 or $9,000 to get to where I want. But now we start to add in the activity that we're doing now. So you can see right now, and again, this is February the 23rd, about 11 p.m. my time. So this is Tuesday. This is the day after that trade. And you can see that I've got an open position right now of about $5,000 of profit in the E-minis. And I just put on these micros right here, and actually up right now on the day, but with the current positions in there that I just opened up, still at a little bit of a loss. But nevertheless, up on that as well. But so if we look at that, let's expand that now, and we can get a better idea of where I'm at. Go to my history tab, and let's stick with the E-minis, and let's go from Monday when we started through today. I'll show you my activity for today in the E-minis, and now there you go. Now there's my total E-mini activity all the way through the day that we started hedging, which was yesterday, Monday, and then the activity that I've done today. Okay. Now we're almost up to $10,000. So I brought in almost $10,000 off of those trades. And of course I got some of the micros working as well. And you can see that that's showing that I'm down right now on this open position that has been marked to market. But I'm pretty confident that this is going to work as well. So that would be step number 2 as I graduate to the E-minis. Okay. Now, if you look at my E-mini position here, let's say that that E-mini trade is not enough, and it's the directional scalping. That's not enough, and in this case, at least so far, it hasn't been. Right? I've got maybe, if you net all of that out that we just went through, maybe $8,000 of the $13,000 loss I've been able to recoup. So I'm still about $5,000 short, right? Okay, so the next step then is I'm going to start to generate some cash flow off of these positions. And if they were long positions in the E-minis, I would sell calls. In this case, they're short positions, so I would sell puts. So you can see that I've got some puts here that I have sold. This is a one-day trade right here, brought in about $1,700. Okay. So this is why I say that, you know, if the market goes down, obviously I get rich on this trade. If it stays the same, I'm okay. And I'm even okay if it goes up just slightly. And I have this high level of confidence that this trade is going to, I wasn't going to say easily. It's not easily going to get my $13,000 back plus a nice profit. But I'm pretty confident that it will happen, right? This is why, right here. So starting to sell cash flow off of this. Now again, premiums change, pricings change, IV changes. So you can't just say every single couple of days I'm going to get XYZ back in terms of profit, but we can approximate, right? And you can see I brought in $1,700 on this hedge in a one-day period. Okay. Now again, premiums are going to change, but $1,700. I did not graduate math college. $1,700 times a 5-day trading week. That's $8,500 there. So in other words, with the position that I've created here, I've got the ability to bring in about $8,000 a week in cash flow. Okay, I've already brought in $8,000. That's booked. That's done. That's not open profit. That is actually realized profit. got the ability to bring in about $8,000 a week in income, week after week after week after week. Now you kind of start to see why I feel fairly confident that getting back a $13,000 loss is not going to be that big of a challenge with that position right there. But even if that is not enough, and so far it isn't enough, right? So far I'm still not back there. It's looking pretty good, but I'm still only at about $8,000 of the let's call it $15,000 that I need. $13,000 to cover the loss, another couple grand for my time and effort. I need a little bit of profit in there, right? So then what is interesting here, I sold this credit put spread right here against this. Now you can see there's my original numbers right there. So what's the difference there? About $1,400. Brought in another $1,400 right there in premium credit for a 1-day period of time. Here's what's cool about this particular trade. And it does depend on who you use as a broker, how they calculate their margin requirements, and if you have a portfolio margin account. Portfolio margin where you are being assessed margin levels based on risk. Very, very beneficial in this situation because I did that trade with zero capital. I did not have to put up a single dime to do that trade because it balanced out the risk of this trade right here. So that trade right there, now I'm up to what, $3 a day that my cash flow is bringing in on that. So that's the next step that I start doing, is doing these free trades essentially, because they simply balance out the risk of the trade. They make it a little bit more delta neutral. My broker with the portfolio margin account doesn't require that I put up any capital, or in some cases just very small amounts of capital to do that trade. And so then, if that is not enough to get us to where we want to be, I start working the trade to adjust the cost basis. Now, I won't go again, we won't have to go through all of the executions, but I've been doing that today, partially to get a better cost basis on these short contracts, these 4 short contracts that we've got in here right now. So we can see, if we go, there you go. If we go to the chart, you can see, and let's just go into a little more shorter term chart here so we can see a little bit. So that line right there, I'm short 4 of the E-mini contracts. And you can see that it's in the money right now, obviously, which is reflected right there, right? You can see it's up $3,600. But I have been adjusting this contract all day long. So what's happening is when the markets come down or up, I will either sell 1 or 2 of those contracts or buy an additional one. Okay, so when the market is high, when it's fluctuating up in the day, I will add another contract. When the market fluctuates down a little bit, I will get rid of that contract. When the market comes way down on that contract, I will book the profit on one of those and let it ride back up. So that's what I did today twice. I have 4 short positions in the E-mini. That's the same that I had at the start of the day. But I sold 2 of those, or sold 1 of those twice today. As the market really got hammered today and came down, I booked the profit on 1 of those, and then the market rose back up and I resold it again, improving my cost basis a little bit. Market sold off again. I sold that for a profit, got out of it. As the market came back up, I resold that again. So you look at it and you're kind of like, man, the market didn't go anywhere today. How did you book XYZ profit? Well, I'm just adjusting my cost basis as we're going along there, okay? And then I guess just the last comment that I'll make on why I really, really love doing this without options. Trading the core E-mini position. So many advantages over options. Number 1, no theta erosion. You don't have to worry about theta working its way into your wallet. Number 2, delta. You guys know that it's pretty much impossible to get an option that has a 1 delta, right? You can get close, but it's not going to happen. And so you've got direct correlation here. You know, a quarter point move in the E-mini, that'll be reflected exactly instantaneously in your P&L. And then last but not least, you don't have to worry about expirations. Now, futures contracts do expire. This one expires in March, the third Friday of March. But we're not in that for this long. This trade, I think, in worst case scenario, I'd have to stick with it for maybe 2 weeks to get my $15,000 of profit back, the 13 to cover my loss, the 2 to cover my time and give me a profit on the trade. But probably, you know, maybe 4 days is generally the holding period for these transactions. So just a little cleaner way to go about that. And, you know, again, we're getting that little bit of a sell-off right now. Not quite into the profit zone on my MES trades, but very close, very close. So anyway, guys, that's how you take a $13,000 loss on a day. And number one, just kind of shrug it off. And number two, have a high level of confidence that you're going to get it back. But it all comes down to hedging. If you are part of our zero date expiration live trading group, you know my saga. You know my saga of GameStop, the crazy meme stock that led this whole new wave of how people look at making money in the marketplace. And when it was about 40 bucks a share, $45 a share, I shorted a lot of positions in it. Just sold the 115 strike price calls, naked calls, sold naked calls, 115 strike price. Stocks at 40.45, selling 115s. How easy a trade, right? Well, it went up to almost $500 a share. And what was a $10,000 margin requirement for me went over a $100,000 margin requirement. And even then, my broker forced me out of a couple of my positions, kicked me out of a couple of my positions. I was hanging on to that trade with the skin, just with my fingernails is all I was hanging on to that trade with. Of course, GME has come back down now, and with adjusting and hedging, that trade might be one of my most profitable percentage trades of all year. It might have been one of my best trades. We've had people, you have heard the stories. Unfortunately, there's some of those stories exist inside of my live trading room where that trade just absolutely blew people up. It absolutely blew up their accounts. And for me, it could end up being one of my best trades of the year. And again, the only difference is how you manage those losses. Do you adjust? Do you adjust? As we're speaking right now, my micros just turned into the profit zone. Just in the profit zone. So, you know, again, just as we've been speaking here, we should have probably been keeping track of those numbers. But this was down maybe 400 bucks, and this was down. This was around $3,000 in profit, and now we're almost $6,000 profit, and this has gone green. So again, hedging is a beautiful, beautiful thing.